What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, it's going to be a little bit different. We're going to talk about the current economic environment that we're in. Now we're going to tie it all into QYLD because a lot of my viewers and subscribers are on this channel from a lot of my videos that were based on income ETFs such as QYLD, RYLD, JEPI, that kind of thing. But the question is, have we hit the bottom? Has the market finally bottomed out? Are we going to go back to a bull market? And if we are, what should we do? Well, in this video, we're going to talk about inflation. We're going to talk about the Fed funds rate. We're going to talk about other catalysts that are currently influencing the stock market. Also, why does the stock market care about those things? And then lastly is, if my opinion is that we finally hit bottom, or we're going to hit bottom on August 1st, for instance, what would I do? What do I think is the best move? So if you're interested in that, let's find out. Now, real quick, before we go into the video, I do have to disclose that I am not a financial advisor. This video isn't financial advice. This is just me talking, giving my opinion. It's up to you guys to do your own research and decide what's best for you and your family. So the first thing we need to talk about is what everybody's been talking about, and that is inflation. Now, this morning at 8:30 a.m., the CPI, or Consumer Price Index, data came out. And what it was is June's inflation was 9.1% more than the prior year. Now, expectations were 8.8%, so we actually came in higher, which is bad. If inflation is higher than what we're expecting, typically the market is going to react negatively to that. Now, why is inflation important? A quick little breakdown on inflation is, if inflation is at 10% for easy math, and last year you had $100, your $100 last year, after you lose that 10% because of inflation, it's only worth $90 today. So all of your purchasing power is going down on a daily basis when inflation is high. Now, some inflation is good, between 2 and 3%, but anything above that, the Federal Reserve and America, they're going to do whatever they can to lower that. And what they're currently doing is raising what's called the Fed funds rate. Well, the Fed funds rate is the interest rate that banks charge each other to borrow or lend their excess reserves overnight. What that means is the cost of borrowing money. So if I'm a business, just pretend that I'm Tesla. If I want to borrow money to invest in my company, then the higher the Fed funds rate is, the more it's going to cost me to access that money. So it's going to be harder for me to grow my business. Back in 2020, when the pandemic first hit, the Fed's fund rate was slashed immediately, and it was at 0. So essentially, it cost businesses nothing to borrow money. Another thing that's tied to the Fed funds rate are your mortgages. So my wife and I bought our house in August of 2020. We were locked into a 30-year mortgage at 2.875%. That is an extremely competitive offer. And honestly, I couldn't be happier that I got that. That rate that we borrowed the money at is fantastic. Only 2 years later, because the Feds have been raising that Fed funds rate, or Jerome Powell, who leads that, now the average mortgage is almost 6%. So if we had bought 2 years later, we'd be paying around 3% more interest than what we're paying currently. Pretty crazy. So if the Fed funds rate is constantly increasing, which is what's happening now, why does that matter? Why does it affect the stock market? Why does it affect QYLD? Well, the stock market cares because it's going to be less likely that businesses are growing. And the whole reason that you invest in a company is because you expect a return on your investment. So every time we have one of these consumer price index releases, which happens on a monthly basis, if inflation continues to go higher, Jerome Powell's response is going to be, I need to raise rates higher. I need to artificially force a recession. Now, it's kind of funny because a recession is bad. That means 2 quarters of GDP are negative in a row. We need to make it cheaper to borrow money because we want people to be spending money and grow the GDPs. It's really fascinating how this is all interconnected. So the question is inflation at a peak? Because if it's at a peak and it starts to go down, more than likely the Feds will stop raising rates and the stock market will stop going down. Well, let's take a look. What you can see here is the results for the CPI, and you can see we went from 6.2, 6.8, 8.5, 9.1. So we continue to go higher every single inflation report. So what this is telling us is that we have not yet reached the peak. Now, in July, it may go a little bit down, and I do have reason to believe that it will, and I'll talk about that in a second. But until we see this start to go down and continue to go down, more than likely, the Federal Reserve is not going to back off on raising the rates. Now, the current funds rate is 1.5 to 1.75. By the end of the year, people are expecting 3.5%, 4%. Now, some people want us to get to that immediately, and other people want us to go as slow as possible because maybe we won't need to go as high. Different opinions. So why do I think that July's CPI, which is going to come out in August, is going to be lower? Well, we see oil tanking. Oil has dropped over 20% since the prior month, and those results aren't showing in the CPI data that was released today. If oil and energy goes down, the cost of almost everything is going to go down as well. So assuming oil continues to trend downward, cost of gas continues to trend downward, diesel, freight, all that kind of stuff, then we should be in pretty good shape. Now, there are other things that are affecting this though. For instance, the war on Ukraine. Now, you're going to hear Putin price hike. It's a bunch of BS. It's not the entire reason that oil is as high as it currently is. Now, does it have some effect? Yes. So assuming that the war on Ukraine ends, then we probably will see some really good results in terms of a decline in the price of the barrel and a decline at the pumps. But there are other factors involved. We also have supply chain shortages, which are causing issues in terms of production. We have COVID lockdowns happening all over the place. I mean, places in China have been doing lockdowns for the past 2 years. They just opened back up, and now there's places that are already considering locking down again because they have like a COVID zero plan. So there's a lot of factors that could negatively impact the market. But as soon as some of these go away, that's going to be a really positive catalyst. So assuming that we've seen the peak of inflation, which is kind of what I actually believe, I think that we are going to start seeing a trend to the upside. I think that this is going to start probably in August. And what am I going to do about it? Well, I can tell you right now, I would not invest in QYLD at the start of what I think is a bull market. So whether you're of the same opinion as me or not, when you think that it's a bull market, you should not be investing in QYLD. You want to take advantage of a quick spike up in tech stocks, in stuff like the NASDAQ, growth stocks. You want to be able to participate in capital appreciation. If you invest in QYLD, you're going to be limiting your gains. Now, if we continue to go up and down like we've been doing, if you look at a stock like Tesla that's been going between 625 and 750 for the past 3 months, that's really good for options plays, and something like QYLD will do really well there. But if we're in a bull market, let's just take a look at the history of QQQ versus the history of QYLD. We're going to talk about why you don't want to invest in income ETFs at the start of a bull market. So right here, you can see this is Robinhood, and the reason I'm using that is because I have some QYLD on Robinhood. I have a little over 500 shares. My average cost is $22, and as you can see, I'm down. I invested $10,000 back in I think like May of 2021, and I've lost like $800. Now, that's actually not that bad compared to QQQ. If you did the same thing, when we look at QQQ, you've got a significant decline, going from highs of 400 all the way down to 286 today. So why do I say that you should not invest in QYLD in a bull market? Well, let's just take a look at this incline. So if we go here from April of 2020 all the way up until the peak, November of 2021, we went from lows around $180 up to the $400, so over 100% increase. If we look at QYLD, back here, the COVID mess, $18 up to a peak of $23 in February of 2021. Now, November 2021 was the peak for growth stocks and tech. We didn't even hit the same amount. 2305 versus 2346. All this growth time for QQQ, when we go back to QQQ, right here, February 336 up to 400, that's a lot of capital appreciation that we didn't participate in QYLD at all. And that's because covered calls limit your capital appreciation. Now, we know this. So the point of this video was to just give my opinion on me believing that we are near the bottom, if not already there, and what I would do, which is not invest in income ETFs, but invest in as much growth as possible at times like this. And then as we get higher, maybe after we get close to previous all-time highs, then I'll start considering putting more into the income ETFs, because I want to participate in as much of that upward movement that's going to be really violent at the start. I believe that as soon as the Fed turns around and says, we're going to actually start lowering rates, we're going to see a massive push on the market. That's just my belief. Maybe I'm completely wrong. Who knows? But at the end of the day, I just wanted to make this video to let you guys know the things that I'm looking at. So the things that I think are important catalysts, such as inflation, the Fed funds rate, the war on Ukraine, supply chain issues, COVID, all those things. As I mentioned, as those things go away or get better, then I'm going to be investing more money into growth to try to capitalize on that. And I've learned a lot in the past couple years investing. Luckily, it's it's a good thing. I'm not planning on retiring anytime soon, so all this is just a learning period for me. I hope you guys are still watching the video. If you are, hopefully you got something out of the video. Let me know down below, leave me a comment. I respond to every single comment on all my videos, or at least I try to. If you haven't already, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to finance or personal fitness. And with that said, best of luck to you guys. Take care.